One of the most popular investment research platforms for institutions and individuals is Morningstar. It gives users access to things like portfolio management tools. It gives them research and analysis and also investment ratings. And just a few days ago, Morningstar released an article stating what they think are the 10 best dividend stocks. So in this video, we're going to be looking at their top 10 list, analyzing why they picked these stocks, and seeing if we agree or disagree. And like always, to analyze these different stocks, we're going to be using the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, and it's exactly how I've been able to make all of these automated spreadsheets. We're constantly adding new features to ticker data, and for example, you can now import a stock's entire dividend history straight into your spreadsheet with one simple function. This is one of the many new features we plan on adding in the future weeks. Now, as we start to dig into this article, let's scroll down. To start off, they pose the question, what should investors be looking for when it comes to choosing the best dividend stocks? So they're going to give us the reason behind the picks that they've made in their top 10 list. And we can see it says at Morningstar, we think the best dividend stocks aren't simply the highest yielding stocks. Okay, to start off, I do agree with this. Now, it depends on many variables and what type of investor you are and what your risk tolerance is and what stage you're at in your investing career. But as a general statement, that is true. It says, we suggest that investors look beyond a stock's yield and instead choose stocks with durable dividends and buy those stocks when they're undervalued. So okay, it looks like the two criteria is durable dividends and buying them when they're undervalued. Again, they make the statement down here in this paragraph, you have to screen for dividend durability and reliability growing forward. So we're talking about sustainable growing dividends and stocks that are currently undervalued. So let's scroll down and see what we have here. We can see they also make the statement that they favor companies with competitive advantages or economic moats. A moat rating does not guarantee dividends, of course, but we have seen some very strong correlations between economic moats and dividend durability. If we come down a little bit further, one of the things we can see, to find the best dividend stocks, we turn to Morningstar's Dividend Yield Focus Index. The dividend stocks on this list are among the index top, and they were also trading in the 4 to 5 star range as of January 3rd, 2025. So let's dig into this Dividend Yield Focus Index for just a moment. If we look at the index description, we can see this index is designed to provide exposure to stocks from the Morningstar US Market Index with attractive dividend yields and strong financial quality. If we look at the performance of this index over the past decade, it is pretty solid. And we can see in 2024, it looks like it returned about 14.21%, which is solid, but it did underperform the market. But here's the huge bright spot. The S&P 500 in 2022 was down about 20%, while this index was up about 7%. That's a pretty impressive outperformance during a down year. So let's start digging into their picks, and we can see pick number 1 is going to be ExxonMobil. This is a company that operates in the oil and gas industry. And here's the argument that they make. Unlike peers that are diverting investment to renewables to achieve long-term carbon intensity reduction targets, Exxon remains committed to oil and gas. While this strategy is unlikely to win praise from environmentally oriented investors, we think it's more likely to be more successful and probably holds less risk. And then to add on to this, they say Exxon is a dividend aristocrat, basically meaning they've increased dividends for 25 consecutive years or more, and they also make the statement they think the stock is worth $135 per share, and shares are currently trading about 20% below that. So there is plenty to dig into here, but if we go ahead and jump over to Seeking Alpha, we can see over the past year, Exxon's up about 8.2%, and they're trading at $106.80 per share. Now let's go ahead and get a general idea of what's going on with the dividend history for this company. If we come up here and plug in ExxonMobil, what we can see is this company currently has a pretty nice starting dividend yield, sitting at about 3.6%, and like we already talked about, a history of growing those dividends over time, over 25 consecutive years. But what we do have to point out is the dividend growth rates have been very low, and in some cases, like when we look at the 5-year dividend CAGR, it's sitting at about 2.28%. That's been below the 5-year inflation rate. So we do have to keep in mind, while technically they have been increasing dividends every single year, anytime you have a dividend growth rate below the rate of inflation, that company is technically paying out less in dividends. So that statement can actually be a little bit misleading. Now, when we talk about oil and gas companies, we have to remember free cash flow can be very, very volatile. And we also have to remember that these businesses can be very capital intensive. So free cash flow payout ratio isn't always the best way to assess the safety of these dividend payments. Typically, for an oil company, we want to look at the earnings payout ratio, which is currently sitting at about 41.49%. And that's a pretty healthy range. Now, if we jump over to the stock screener and plug in ExxonMobil, again, like I already mentioned, revenue and earnings, free cash flow, this is all going to fluctuate a whole lot. And the reason behind this is the revenue this company generates is heavily tied to oil prices. And this is a volatile commodity. For example, at its low in 2020, we can see oil was about $18. And then when it hit its high in 2022, it got up to about $116 to $118. Now, perhaps the most interesting statement that Morningstar stated was they believe that shares are about 20% undervalued as of right now. That's a pretty big statement. That's a decent undervaluation. And if we jump over to my free cash flow analysis sheet, I've already plugged in ExxonMobil. Look at the starting free cash flow yield for this company right now. Over the trailing 12 months, it's sitting at 7%. So what this is telling us, for every $100 we invested in this company, they generate about $7 in free cash flow for us. Now, the 10-year average for this company is sitting at 4.48%. So investing in this company right now would give you more free cash flow than it would for the 10-year average. This means we're looking at a pretty good valuation. Now, there is a caveat to this. And that caveat is, again, free cash flow can be very volatile. So what's the company expected to do in the future? Are they going to grow earnings and grow free cash flow? Well, if we jump back over to Seeking Alpha, let's look at the earnings estimates from analysts. What we can see is, yes, they are expecting a bit of a dip when they report their Q4 2024 earnings, but after that, earnings expectations are decent. We can see slight growth in 2025, but in 2026 and 2027, it's projecting pretty solid growth. So when it comes to the ExxonMobil pick, I don't hate it, but I will say the dividend growth rate is low. And I'm not a huge fan of investing into stocks that have such volatile earnings and free cash flow. I much prefer predictability and reliability with the investments that I make. Now, if we scroll down, we can see pick number 2 is going to be Johnson & Johnson. Johnson & Johnson is a drug manufacturer, and we can see they make the statement that this company is a dividend aristocrat, but that's actually a mistake. This company is a dividend king with over 50 consecutive years of dividend increases. And they say the stock is trading about 12% below their fair value estimate of $164 per share. They say with a diverse revenue base, solid pipeline, and exceptional cash flow, the company earns a wide economic moat rating. Now, the key statement right here is solid pipeline. We have to remember, with these drug manufacturing companies, their growth is almost solely dependent on what drugs they have in their pipeline. And so if you go over to their website, you can actually get a pretty good overview of what's in the pipeline right now. Now, what Morningstar also mentions is they also have some litigation risk hanging over the stock. And they're absolutely right. Over the next decade, Johnson & Johnson is estimated to pay about $10 to $15 billion in lawsuits. So how is that going to impact the stock? Can they sustain that? Well, if we jump over to Seeking Alpha, we'll get into that in just a moment, but the stock is currently trading at $142.69 per share and is down about 11.6% in the past year. Now, what's interesting about the starting dividend yield at these prices, if we scroll down and zoom out just a little bit, we can see Johnson & Johnson now has its highest starting dividend yield in the past decade. And again, this is due to growing those dividends, but more importantly, due to the huge sell-off, giving them a higher starting dividend yield. So if we jump over to my dividend breakdown sheet, come up here and plug in J&J. What we can see is the starting dividend yield is sitting at about 3.44%. And again, as a dividend king, they have a history of growing those dividends. Now, the dividend growth rate this time is above the rate of inflation, but it's still not the most impressive. But I will say it's decent for a company that's been growing dividends for over 50 years with a 10-year dividend CAGR of about 6%. Now, what we really need to look at with this company is going to be the balance sheet. How will the company be able to handle those future litigation payments? So if we come up here and plug in J&J, here's what we really want to point out. If we go ahead and zoom in, we want to take a close look at cash and cash equivalents. We can see at the end of the most recent quarter, Q3 2024, it was sitting close to about $20 billion. So $20 billion in cash and cash equivalents, and if we look at the current ratio and debt to assets ratio, it appears total assets is easily covering total debt and total current assets is covering total current liabilities. Now, the concern here is the current ratio has been trending downward over time. So that is something Johnson & Johnson will have to manage. But when we look at cash and cash equivalents sitting at $20 billion, and also consider the fact that if we jump over to Seeking Alpha, look at the earnings estimates over the next few years, they're still projected to grow earnings at a decent rate moving forward at the next 4 to 5 years for a more mature company. So when I think about the lawsuit payments, I take into consideration cash and cash equivalents is already sitting at $20 billion. The company's projected to grow earnings at about 5 to 6%. Overall, I think they will be able to manage those lawsuits. Now, I will say this is not a high growth company. This is a company that pays a reliable dividend and it has a decent starting dividend yield at its current prices, close to about 3.44%. So if you're an investor looking for low volatility and predictable dividends, yes, I would say Johnson & Johnson is a decent pick, but if you're a long-term investor, there's probably better options out there. Stock number 3 is another oil company, oil and gas. We have Chevron, and we can see if we come down here, they're estimating that it's trading 16% their fair value estimate of $176 per share. Now again, with this being an oil stock, obviously there's a lot of volatility. For example, if we jump over to my free cash flow analysis sheet, let's come up here and plug in CVX. Here's what we really want to pay attention to. If we come over here and take a closer look at the free cash flow analysis tab, I want you to pay attention to free cash flow margin. What is this telling us? Well, it's telling us what percent of revenue is actually becoming free cash flow. So for example, if we look at 2023, free cash flow margin was 10.05%. So for every $100 in revenue the company generates, about $10 became free cash flow. But look at how much this has fluctuated over the past decade. From 2013 to 2016, this number was actually negative. And again, these oil companies do have higher capital expenditures, which plays a major role in this. But the point remains true. There's a lot of fluctuation here, a lot of volatility. Now, if we jump over to our dividend breakdown sheet to look at this company, plug in CVA, they're currently yielding about 4.26%. So this is one of the largest yields that we've seen yet. That is a big dividend payer. And the 5-year dividend CAGR is pretty decent for that high of a starting dividend yield, sitting at about 6.49%. And we can see really the dividend growth over the past 5 to 6 years has increased quite a bit, because for quite some time, 2013 to 2018, the dividend was growing, but not at a high rate at all. The 10-year dividend CAGR was sitting at about 4.47%. So if we jump over to Seeking Alpha, we can see this company was actually up about 6% over the past year. And if we look at just the past month, looks like they're actually down about 2.5%. So when it comes to Chevron, yes, maybe oil stocks are a little undervalued at this moment, but it's not something I would add to my portfolio. Stock number 4, we have another healthcare stock, and that is Merck. And again, second healthcare stock on their list of the best dividend stocks to invest in. And they believe the stock is trading 17% below their fair value estimate of $120 per share. They state that the company's balance sheet is sound and carries low risk, and they expect steady future dividends supported by a payout ratio of close to about 50% relative to adjusted earnings per share. Let's see if we agree. Let's go ahead and jump over to our balance sheet and come up here and plug in MRK. Just off a quick glance, we can see things do look pretty good with the balance sheet. Debt to assets ratio only sitting at 0.32. And again, that's simply total assets divided by total debt. And then current ratio, total current assets divided by total current liabilities. And typically what we want to look for with the current ratio for most industries is going to be a current ratio of above 1, and they're sitting at 1.36, so they're in a pretty healthy range. If we go ahead and jump over to our dividend breakdown, come up here and plug in MRK and hit enter. And we can see we have a starting dividend yield sitting at 3.13%. But here's the huge red flag a lot of people are going to point out. To start off, yes, a 5-year dividend CAGR looks good at 7.8%, but the payout ratio is showing about 2,039%. Why is that the case? Well, if we jump over to our stock screener, come up here and plug in MRK, what we can see is earnings per share saw a massive decline in 2023. From 2022, it was at $5.73, and in 2023, it dropped all the way to 14 cents. So obviously, those dividend payments wouldn't be sustainable if something didn't change. But if we look at expectations over on Seeking Alpha for the earnings over the next few years, we can see it's not only expected to recover, it's expected to go quite a bit higher. By the end of fiscal year 2026, earnings could be as high as $10.38 per share. And if we compare that to where they are as of the end of 2022, it's close to being double. And with the company currently sitting on a free cash flow yield of about 5.88%, the valuation does look decent. And if we jump over to Seeking Alpha, let's go ahead and look at how they've traded over the past year. We can see down about 16.1%. And if we look at them in just the past month alone, down about 2.36%. So this is definitely one of the more interesting picks on this list, one that I'd probably pay attention to a little bit more than the others. And then coming in at number 5, we have PepsiCo. This is a stock I've been talking about on Twitter quite a bit lately, and it says the industry they operate in is beverages. But if you actually look at the revenue breakdown for this company, they generate more from food. Now, obviously, but yes, beverages is a big part of the business as well. But we can see this is the 4th dividend aristocrat on this month's list of the best dividend stocks to buy. And they think Pepsi stock is worth about $174 per share, and shares are down about 14% below that at the time of this writing. And despite near-term headwinds from consumer belt tightening in the US, they think PepsiCo remains poised to bolster its competitive standing in beverages and snacks by leveraging marketing and product initiatives. And to be honest, in my opinion, that's kind of a vague statement. But let's go ahead and dig into this one. If we look at Seeking Alpha over the past year, Pepsi's down 15%, but most of this sell-off has started in mid-October when they were trading as high as $174 per share. If we go ahead and jump over to our dividend breakdown, let's look at Pepsi. We can now see the starting dividend yield for this company sitting at 3.75%. So the yield has continued to climb higher and higher, and they have a pretty nice history of growing those dividends at a rate of about 7 to 8% over the past 5 to 10 years. So that's a pretty nice combination of dividend growth combined with starting dividend yield. And we can see the payout ratio is about 73.6%. So they are using most of their earnings and most of their free cash flow to pay out dividends. So there's not as much cash flow being reinvested back into the business. Now, Morningstar believes Pepsi's undervalued. Let's analyze that statement. If we jump over to my stock valuation sheet, come up here and plug in Pepsi. There's 2 different valuations that I want to look at. To start off, let's look at the historical multiple valuation. And basically what we're doing is looking at how the market has historically valued this company. We can see their PE ratio charted out over the past decade. The average PE ratio over the last 10 years was sitting at 25.21, and for the trailing 12 months, it's now sitting at 20.83. That's about 17.5% lower than the average PE ratio. And unless something has fundamentally changed about this company, this would lead us to believe the company is undervalued. But it doesn't stop there. If we jump over to a dividend discount model, we can see if we assume a 4.75% dividend growth rate for Pepsi and a discount rate of 8%, we come to a dividend discount model price per share of $171.79 per share, which is about 21% higher than the current share price for this company. So when it comes to the statement that Pepsi looks undervalued at about 14%, I'd argue they're even more undervalued. Now again, to be perfectly clear, this is not a high growth stock by any means. If we look at projected earnings again for this company, we can see we're looking at mid-single digits over the next decade. But again, with PepsiCo, you're getting a pretty nice high starting dividend yield combined with decent dividend growth and earnings growth. Depending on what type of dividend investor you are, this one could be a good addition. And then we have Medtronic. This is a company in the medical devices industry, and they're claiming it trades 28% below their $112 fair value estimate. And the largest pure-play medical device maker is a key partner for hospital customers thanks to its diversified product portfolio aimed at a wide range of chronic diseases. Now, here's what's interesting. They say the company aims to return a minimum of 50% of its annual free cash flow to shareholders, but it's been in the 60 to 70% range in the recent year. Now, when they talk about returning 50% of its free cash flow to shareholders, what does that mean? Well, we have to remember there's 5 different things a company can do with free cash flow. 1, they can reinvest back into the business. 2, they can pay down debt. 3, attempt mergers and acquisitions, but the 2 way to directly reward shareholders is by buying back shares and paying out dividends. So let's analyze that statement. If we jump over to Seeking Alpha, first off, we can see yes, this company is down about 6.78% in the past year, trading at $81.18. But if we look at the dividend, the starting yield is sitting close to about 3.4%. So a decent starting dividend yield. And if we look at the dividend history for this company, yes, we'll see they have been growing those dividend payments for about a decade now. But let's analyze the other part of that statement, which means share buyback, another great way to potentially reward shareholders. If we come down here and look at shares outstanding for the company, we can see it looks like they issued new shares from 2015 to 2016, but since then, they have been slowly but steadily buying back some shares. So some free cash flow is being used for share buybacks. Now, if we look at the free cash flow yield for this company, it's sitting at about 5.28%, which is generally a good valuation, but again, it depends on their ability to grow free cash flow. So if we jump back over to Seeking Alpha, again, let's look at the earnings estimates for this company. We can't see we're looking at mid-single digits like we've seen for most of these companies. So we're starting to see a trend with all of these picks. We're looking at a dividend yield of about 3 to 4% with mid to single digit earnings growth expectations. So what this is telling me is this list is for people looking for low volatility, predictable dividends. And there's definitely people where that can be a great strategy depending on your goals and where you are in your investing journey. But for a lot of people like myself, I want to seek out more growth and more dividend growth. But let's keep moving forward, and we can see our next pick is going to be Mondelez International. And if we come down here, we can see the argument. They have a portfolio of brands that includes Oreo, Chips Ahoy, Halls, and Cadbury. And they think the firm has a wide economic moat. And then if we come down here, we can see they state we forecast the company will increase its dividend in the high single-digit range on average through fiscal 2033. We think this dividend stock is worth about $75 a share and trades 20% below that. So let's analyze that statement. To start off, high single-digit dividend growth is pretty decent, especially if we jump over to Seeking Alpha. We can see in the past year they're down 23.24%, and if we jump over to my dividend breakdown sheet, we'll plug in Mondelez. What we can see is the starting dividend yield is now sitting at 3.32%. And they stated they expect dividend growth to be in the high single digits. And if we look historically, it's been even higher. The 10-year dividend CAGR is very good at 12.5. The 5-year, 11.5. So dividend growth has been very good for this company over the past decade. So right now, you have an opportunity to buy this company at one of its higher starting dividend yields due to the sell-off with projected very nice levels of dividend growth. And the payout ratios are in a pretty healthy range, meaning dividend growth should be sustainable in the future. But here's what you have to know about this company. Jump over to the profitability tab. Come over here and plug in Mondelez. Here's what I want you to pay attention to. Look at the gross profit ratios. Last year, sitting at 38.22 and the 10-year average at 38.47. So far, that looks pretty good. It's in line with the 10-year average. But let's take a closer look at what happened in the most recent quarter. Using the ticker data function, again, we're going to go ahead and pull in gross profit ratio in Q3 of 2024. And what we can see is it came in at 32.58% when last year it was at 38.22%. Why is this? Well, commodity prices, especially cocoa, have been skyrocketing over the past couple of years. And this is playing a major role in the underlying fundamentals of this company, and this is passing on higher costs to the company. So that's a clear headwind this company is currently having to fight through. And it's not going to go away overnight. It'll probably take a couple of years. But with that being said, I think this is one of the more interesting picks on this list, one that I'm going to be paying attention to a little bit closer. Our next pick is going to be Schlumberger, stock ticker SLB, and they operate in the oil and gas equipment and services industry. And this is now the third energy stock on the list of best dividend stocks to buy, so they seem to like this industry quite a bit right now, and they claim the stock is 32% below their $57 fair value estimate. And what they say, over the near term, there are some struggles for the company, but they still like them for the long term. They describe them as shareholder friendly, and they expect that management will return about 70% of free cash flow to shareholders in dividends and or buybacks. So if we go ahead and jump over to Seeking Alpha, this is another stock down about 20% over the last year. So we're starting to see another trend out of their picks. Most of them are down over the past year. And if we jump over to our dividend breakdown, all this data will load in, and immediately we can see a huge red flag. Look at what happened to this company's dividend during 2020. It got reduced dramatically from about $2 all the way down to 88 cents per share, and then again in 2021 they paid out less in total dividends. Now they started to grow that dividend over the past few years. It started to get re-hiked, but it's still not at the 2019 level. So yes, the starting dividend yield is 2.82%, but just how confident are you in holding a dividend stock strictly for the dividend if they haven't been able to sustain those dividend payments over the past 5 or 6 years? For me, that's not something I would want to buy. So with that being said, I don't really have anything else to say about this company. It's not something I'm interested in. Next on our list, we have LYB, and this is the highest yielding stock on their entire list of best dividend stocks to buy, and they believe it's about 37% undervalued, and they believe it should be about $115 per share. So that's a pretty big undervaluation according to Morningstar. The company has increased its annual dividend payment for the past 12 years straight, so pretty good track record, averaging 12.5% growth per year since 2012. So that's really good dividend growth over that time period. Let's go ahead and start to break it down a little bit more. If we jump over to Seeking Alpha, we can see in the past year, they're down about 24.5%. Now, if you're not familiar with this company, they operate in the commodity chemicals industry. We can see they're a leading global chemical company known for its production of a variety of chemical products. Now let's jump over to our dividend breakdown sheet. What we can see is, yes, a massive starting dividend yield sitting at 7.23%. So we're talking about big dividend payments. And if we look at the yearly dividend payment chart, look at what happens in 2022. If we scroll down, it looks like they paid out a special dividend on that date because they had an abundance of earnings. The 10-year dividend CAGR is pretty good at about 7%, but it's slowed down a little bit over the past 5 years, closer to about 5%. Now, we can see free cash flow was trending downward from 2014 to 2020, but then we saw a huge spike up in 2021, but it started to slow down quite a bit once again. And as of 2023, the free cash flow payout ratio was sitting at about 47%, the payout ratio as a result of earnings at 76%. So if we go ahead and jump over to our stock screener, come up here and plug in LYB. Something that we definitely have to point out is this company's also bought back a lot of shares outstanding over the past decade, going from about 548 million shares outstanding all the way down to 325. Anytime you buy back shares, it's going to boost all of your other per share metrics, and this can be a great way to reward shareholders, especially if you're buying back the stock when it's undervalued. And we can see right now the free cash flow yield for this company sitting at 6.71%. So you're getting about $6.71 in free cash flow for every $100 you put into this stock right now. And if we look at estimates for this company, here's what we're going to see. Once they report Q4 2024 earnings, it is going to show a drop in earnings, but after that, we're looking at pretty solid projected earnings growth over the next couple of years. So far, this is probably one of the more attractive opportunities that I've seen on this list. And then finally, we have General Mills operating in the packaged foods industry, and you can see here they have a portfolio of somewhat popular brands, and they state they have a narrow economic moat. The company's paid a consistent dividend for decades and has only paused increases when addressing post-acquisition leverage, and they believe the stock is about 10% undervalued as of right now. So if we jump over to Seeking Alpha, we can see in the past year, this company's down about 9.21%, trading at $58.69 per share, with a pretty decent starting dividend yield, currently sitting at about 4%. But here's what I also want to point out. Short interest sitting at 4.31%. That's a little bit higher than I typically like to see it, and it means there's a lot of institutions actively betting against this stock. And if we jump over to our stock screener, here's one of my concerns with this company. What we can see is revenue growth has been slow. It's been very slow. 2013, $27.40 per share. If we look at revenue per share in 2023, $33.78. So again, growth has been very slow. The same is true with earnings. They've grown a little bit more with earnings, but but it's still slow and free cash flow per share has been slow. But we have to remember a free cash flow yield of 8.66% isn't as attractive if the company's not going to be growing free cash flow at a decent rate. And if we jump over to Seeking Alpha, look at the earnings estimates for this company, we can see we're looking at low single-digit growth. So overall, this one's growing earnings and free cash flow just a little bit too slow for my liking. So there you go, those are Morningstar's top 10 stocks to buy. Again, out of this list, I think there are a few interesting opportunities, at least when it comes to my personal situation. I'm looking at Merck, I'm looking at PepsiCo, I'm looking at LYB and MDLZ, Mondelez. But overall, it appears that these stock picks are definitely geared towards people who aren't as concerned as the overall growth of the business. These are picks for people looking for immediate yield, low volatility, and stable and predictable dividend payments. Those are all great qualities, but overall, I personally want to see more dividend growth out of my holdings. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.